So the battle for what is money and who controls it just got really interesting. At the start of the year, some investors apparently made a bet that gold could be worth as much as $20,000 per ounce by the end of the year. Now today, gold is worth closer to $4,000, but what's interesting is that on June 24th, one of China's biggest banks, the Industrial Commercial Bank of China, or the ICBC, announced that they were shutting down their paper gold trading for their retail investors. What does that mean? That means on July 24th, if you're a Chinese citizen who wants to trade gold through their bank, your access will get switched off. Now, the ICBC is not the only bank doing this. It was also their Postal Savings Bank of China that did it first, then Ping An Bank, then China Guangfa Bank announced it in June. So some of their biggest financial institutions, one after another, are now pulling the plug on retail trading. Right, the question is, why is China doing this? The official story that they're telling us is that they are protecting citizens from the volatility, right, the extreme up and down movements of gold. They're doing this because back in January 29th, spot gold hit an all-time high, over $5,500 per ounce, but then it crashed. As I'm making this video, gold is trading at around $4,000 per ounce. That's a drop of about 28% from the peak. So of course, to protect people, China's banks have increased what's called the margin requirement to 140%, which is a record high for the industry. A margin requirement, by the way, is the amount of collateral someone needs to borrow money. And by increasing that percentage like they just did, it means you need to have a lot more money to borrow less money. China is now demanding more collateral than what the investment is even worth. Okay, so the official reason is gold is volatile, retail traders are getting hurt, and big government has to step in to protect them. Now, the unofficial story, though, is probably what's actually happening, which is the battle for real money and what that money should be worth. Right? Think about what China is really shutting down. They are getting rid of margin trading. They're getting rid of the leveraged deferred contracts, the paper gold. Basically, the easiest way to understand it is they are getting rid of the speculation, the gambling. But physical gold, that's all good. They could still buy and sell that. They're not stopping people from owning gold. They are stopping people from trading the paper claims against gold. Okay, so why is China doing that? The theory says it's because the real price of gold should be way higher than it actually is. But the reason that it's not is because it's being manipulated and suppressed by the paper markets, and it has been for decades. So in order to have what's called real price discovery, in other words, in order to figure out what something's really worth, you need to first shut down people's ability to gamble on the price of it. Now, if this were true, we'd probably see China, as a nation, start to buy a lot more gold than usual. And that's exactly what they've been doing. In May of this year, they bought 163 tons of gold, the most since March 2024. And that's not just true of China. That is true of all central banks around the world, which have been buying way more gold. In fact, as much as 15 times more than they've been telling us. It makes sense, right? Which is also why the Chinese government is launching a brand new gold clearing and settlement system. It's a system that's designed to make China, not London or New York, but China, as the place where the price of gold actually gets set. Now, once you put all of this together, central banks and nations secretly buying gold and taking steps to get rid of the paper markets and building the settlement hub there, it all starts to make a lot more sense. So today, let's speculate on what could be really happening and why China's doing this right now and what it all means for our investments and the dollar. So with that said, let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the battle of money and gold. So to understand why China shutting down their paper gold market is such a big deal, you have to first understand what paper gold is and how it works. And the easiest way I can explain it is like this. Let's say I've got this sick Pokemon card called the Ancient Mew, right? It's a physical card that is sitting in my safe. It's real, I can hold it, there's only one of it. Now imagine then, I write up a little paper certificate that says, this entitles you to one of these Mews. And then I sell it to you. Right? You're happy because you've got a claim on my card, but maybe you don't actually want to custody the card because someone might steal it and you're afraid. So you just hold the certificate. It's easier. It also trades like the real thing. But you never come to collect it from me. So here's the problem. Once I realize you're never actually going to show up and ask for your card, what stops me from writing a second certificate and then selling it to someone else? And then a third, and a fourth, and a 10th, right? Now, there's 10 people who think they own this Mew, but there's still only one card. I've sold 10 claims on it though. On paper, the supply will show that there's 10 Mews. In reality, nothing's changed, right? There's still one card in existence. So what's it really worth? Well, if the market is pricing my card based on the evidence it has, which is all that paper floating around, the price should be 1/10 of what it should be worth. Because as far as the market can tell, these Mews are everywhere, right? Why would the price go up when there's so much of them available? That's paper supply. Now, the second everybody walks in at the same time and says, you know what, Andrei, actually, I want my card now, the whole system would fall apart because 9 out of 10 people would find out that their paper certificate is worth nothing. That is the overly simplified version of paper gold. Now, in the big Western markets like London and COMEX in New York, most gold that trades every day is never physically delivered. They're what are called contracts. They are claims. People buy and sell these pieces of paper that represent claims on the gold. And the majority of people never intend to take a single physical bar, right? Same as the Mew example. And just like my card scheme, that means they can also write way more claims than there are actual pieces of metal sitting in their vaults. Now, estimates for how much paper gold there is varies because no one knows how much gold there really is in the world or how much paper there is. But the point is, there is dramatically more paper than there is physical real gold. What that means then is that the price of gold today is probably lower than where it should be. That's how you suppress the price of an asset. Now hold on. Where's my proof? Like, I can't just say, we think there's more paper gold there, trust me, bros. If what I'm saying is true, how would we know? There's a couple ways that we might know